Well, hello, everyone. Welcome, welcome, welcome. We're so excited to have you at today's keynote series, the title of which is Driving Returns Through Entrepreneurship. My name is Andrea Polito, and I am the CEO and founder of SimplyFed. We're a seed stage company tackling infant nutrition. I'm also a part-time lecturer at Cornell, where I work and direct this program called We Cornell, or Women Entrepreneurs Cornell. And we have a live watch party for students attending on campus. So hello to all students that are here, and hello to all of you virtually that are attending today. So thanks so much for joining. The goal of today's discussion is to talk about ways to increase access to whole stakeholders across the United States, across the world, to entrepreneurship. Ways to become a founder and participate in the entrepreneurship ecosystem. Ways to become an investor and a funder. And our goal here is to increase access to this ecosystem because the world is facing a tremendous number of challenges right now. Whether that's the climate crisis, health tech, and the major pandemic we're facing, or ways to serve the underserved that currently are not being reached, homelessness, whatever that sector might be, the time is now to increase access and get the best and the brightest developing new innovative solutions. So the goal of today is to shed light on ways that we can increase access to entrepreneurship because it's such an important lever to innovate and make change. So join with me here today are two incredible panelists, Marla Beyer, who graduated from Cornell in undergrad, and right now she's the CEO and co-founder of Hopscotch, and she's going to share more about Hopscotch in a few moments. And Momo B, who also got her MBA at Cornell, and she's a senior director in New York Ventures, or at New York Ventures. And so this panel is full of just tremendous experts on both the founder side and the investor side. And we're going to talk about the pathways to each. So before we get started with our discussion, I'd like everyone to take out their phones and shoot the QR code that's on your screen, because we want to know where you are from, and we want to get to know you in the process. So get out those phones and tell us where you're from. And by the way, make sure to keep those phones out because we're going to have some other items for you to interact with throughout our discussion today. So with that, enough about me, because the most important part of this discussion is our incredible panelists. And the way we're going to structure this is first, we're going to have them discuss their backgrounds, how they got to where they are today. Then we're going to talk through Marla's founding journey, and then Momo's pathway to becoming an investor. And then our true goal of today is to then increase access and transparency to how they got there, but also to demystify some of the terms that frankly get thrown around way too often that keep people out. And so we're going to share what some of these terms mean and also ways for you to interact and ways to improve this ecosystem in the process. So let me turn it over to our first panelist. So Marla, thanks so much for joining us here today. Before we talk about Hopscotch, would love to learn a little bit more about your background and how you got to where you are today.
Absolutely. Thank you so much for having me, Andrea. I'm so excited to be here, and welcome to all the attendees. I'm really excited to just share more and hopefully demystify some of the experience of entrepreneurship and fundraising for those of you who are either doing something, working for something, or looking to do something, a project on your own. So a little bit about Hopscotch and my founding story. I was working at a children's hospital in Buffalo, New York, and I spent about 2 years there coordinating and managing NIH-funded clinical trials in the pediatric behavioral health space. And so in this role, I was really patient, family, and clinician-facing, and had the opportunity to interact with hundreds of children and families accessing behavioral health care support. And it was primarily a Medicaid population. So I was able to see just how stark the disparities to this type of care exists in the space. And so I met over hundreds of families and children accessing this type of care, was able to see just how difficult it actually was for these families to access really needed pediatric behavioral health care. And then furthermore, even for children who were able to get into the care delivery setting, I was seeing how challenging it was for their clinicians to really deliver an effective, engaging care experience, and one that extended beyond the office. And so something that is challenging is really being able to effectively engage families and children in care beyond the office. But with the current intervention toolkit that these providers were using, which was composed of paper-based worksheets and handouts, they were really having a difficult time of driving this continuous care delivery. And so I decided that I wanted to build something in the space to really increase access to this type of care, but also drive engagement that extended beyond the office setting and really empower these providers to deliver a comprehensive care experience for their patients and their patients' families. And so I ended up deciding to attend Cornell for business school, where I went for my dual MBA, MHA. And during my graduate school experience was really where the foundations of Hopscotch first started to happen. Started off by conducting over 250 interviews with clinicians, delivering this type of care, families accessing this type of care, and children who are also receiving this care, just to understand a better sense of each stakeholder's point of view and the respective challenges that they were facing from their perspective. So I worked on Hopscotch throughout the course of my 2 years in graduate school, and over the course of time went through everything from initial customer discovery, really being able to deeply understand the pain points, challenges of the stakeholders, a general sense of the ecosystem and the various stakeholders in a highly regulated industry such as healthcare. Started to build out an MVP, low fidelity mock-ups and prototypes, and started to build a team and really set the foundation for being able to officially start and launch Hopscotch upon graduation when I graduated from business school. And then from there, things started to get really interesting. And so I ended up, after working on it with my co-founder for about 6 months on our own, we decided to do an accelerator program in New York City, wherein through this accelerator, we accepted about $100K in investment on a safe, and I can talk a little bit more about that, but it's a security wherein when a company is early on and it's difficult to set a valuation, they'll want to defer putting a valuation in the company in the form of a safe. So the investor in this case, a ERA, which was the accelerator, they took a portion of equity of our company, but that actually won't convert until shares until we raise a price round in the future. And so it's a good way for early stage companies to really raise this money quickly without having to set a valuation on the company. And so we did the accelerator program, launched our product, and grew our user base to over 3,000 clinicians across all 50 states, which was really exciting. And then upon our graduation from our accelerator program, we raised a couple $1 million in seed funding from a number of top investors, one of which is Momo here with New York Ventures, and we feel very fortunate to have them on our cap table and partners in this journey. But after fundraising, we began to grow the team, expanded our operations, and are now launching partnerships with a number of top children's hospital systems, and are continuing to grow our user base, and really excited about all the opportunities that are to come for Hopscotch, and just being able to expand care to more children and families and really serve the clinicians in this ecosystem, which are really pivotal to being able to expand access to care and treat children and families that really need this type of care. And so it's a little bit on me and Hopscotch, and more than happy to answer any specific questions later on.
Thanks so much, Marla. And one of our goals here today is to bring back the process and actually shed light on what this looks like. So thanks so much for walking us through your journey. Now, I want to go a little bit deeper into two of the terms, then I'm going to turn it over to Momo. First, can you describe what you mean by MVP? What does that look like? And what does that mean in the entrepreneurship sense, not the Tom Brady sense? You see my
So for an MVP in the entrepreneurship sense, this is your minimum viable product. And so especially early on, before you've raised any sort of funding, before you have a lot of resources and tools, you need to be really scrappy. And you want to begin as early as you possibly can to begin to test out your hypotheses with hopefully actual customers and users of your product. And so what you want to do with your MVP is you want to try and figure out, what are these core hypotheses that I need to prove and or disprove in order to validate either my business model, my value proposition, my key services that I'm looking to offer to my customers. And you want to do that in the lowest fidelity way possible so that you can quickly get feedback and quickly test without building and spending a lot of time building and resources a really bloated solution that ultimately might not be on the mark of what your customers or users are really looking for. And so an MVP can look really different depending on exactly what you're looking to test. But in some cases, it can be as simple as a landing page where you're just looking to see, are people signing up? Are we seeing that conversion from an initial cold outreach or email? So that's a common MVP you'll see. In our case, we were looking to gather some data from children and families on some of our digitized programs and treatment programs that we were offering to families. And so we worked with a team of about 4 computer science undergraduate interns and offered them credit. And they worked with our CTO to build out a really low fidelity mock-up of not mock-up, it was actually a responsive web application. But looking back on it now, it was like the D- version of what Hopscotch is today. But we were able to get feedback from users, and we were able to see what wasn't working, where we were losing users, but also what was, and really dig into that and what was working. So it's a way where you can just get something out quickly, start to get feedback and test, and then upon that, you'll continue to iterate and improve. So that is an MVP, and it will look different depending on whatever those really core hypotheses you're trying to test are.
I love it. So you've heard it here from Marla. It's the D- version where you get to test out that willingness to buy and use. I love that. And then one other quick question for you before I go over to Momo is, can you describe what an accelerator is? You dived into it a little bit, but what is an accelerator and why would a founder want to participate in one?
Yeah, absolutely. So an accelerator is a program in which they accept startups. So it's essentially it's an incubator of mentors, investors, wherein they have multiple cohorts that run. I'm so sorry. My dog is scratching at the door. Let me just let him in.
I can jump in here. So the accelerator, they usually invest in a small check and then they take a small portion of the company, but they provide mentors in all different areas of expertise. For example, ERA, where Marla went through, they have Investor Week where they put in like hundreds of investors to do mentor sessions with the founders. They have experts in UI UX design. So it's basically for a new and young company to very quickly be able to try many things, test them out, and be able to learn the lessons from the experts who have done this like 10, 20 times.
I love it.
Thank you, Momo. And yeah, sorry about that. Gotta love virtual work from home life. Yeah, and so the purpose of an accelerator is to really help prepare you to raise institutional VC funding upon graduation, ideally. And so a lot of the benefit that we received through the accelerator was working with really seasoned investors who could provide us feedback on our pitch deck and materials and help us refine and improve our language and messaging and essentially pitch, so that when we went out to raise our seed round officially, we felt like we had gotten enough shots on goal and enough practice with seasoned people in the space to help us really successfully make that transition into full-time fundraising.
Excellent. And we're going to get into what institutional investors look like and shed light on that. And it's a perfect segue. So speaking of seasoned, experienced investors, I'm really excited to introduce Momo V. And she is Senior Director at New York Ventures. So Momo, tell us a little bit more about your background and your pathway to becoming an investor.
Yeah, sure. And I'm really excited to be here. Thank you for having me. So I actually grew up in Shenzhen, China, which is the first city to take foreign investment. And it's the first city, it's the frontier of technology. So when I was growing up, I really saw how investment and entrepreneurship can completely reshape a city from a sleepy fishing town into an international center of technology. So with that, when I was 16, I came to the US and I wanted to, see the world and experience different things. I studied international affairs in college, and afterwards I worked for an international consulting firm where my focus was in B2B sales. So I did B2B sales for about 5 years. In this process, also as a consultant, working with a lot of the technology entrepreneurs, but also very large companies and banks such as Wells Fargo, Gulfstream, Raytheon, Lockheed Martin. And I have learned so much about, how the business development side of almost every single type of business. And from there, I came to Cornell and did my MBA here. While I was at Cornell, my finance professor talked me into going into asset management, and he was so right about this. Asset management enabled me to study every single asset class in the finance world, and I've always thought venture capital was such an interesting piece of this finance world. When I first came back from studying abroad while I was at Johnson approached me and asked if I would like to be they said connecting the student body kind of role to go to Cornell Tech for a semester before graduation. So I went to Cornell Tech, and when I was there, I joined a startup. We built a virtual reality fitness program for biking, where you can simply bike at your stationary regular bike at home, but with our app, you have the ability to be riding Tour de France. We were able to pitch many investors, including Aaron Holiday, who's the GPS 645 Ventures, and he became a great mentor of mine after I graduated, went to JP Morgan, and decided that I wanted to do something different. I went to see Aaron Holiday, and he gave me the great advice of looking into venture capital. And, thinking back to my journey thus far, I had the most fun when I was at Cornell Tech building a company, working with investors, and realized that it is the perfect intersection of everything I've learned in life in terms of being able to contribute to a lot of different companies in business development and sales, having the understanding of finance, but at the same time sharing the passion and the vision with entrepreneurs who are really going out there and building their own business. So with that, I eventually joined New York Ventures. New York Ventures is New York State's venture capital fund. We invest in early stage companies with the hope that we are really looking for founders and companies that are true game changers to increase people's quality of life. And we invest in companies that are based in New York. It's also important for us to invest in diverse teams because we believe they bring superior performance. So that's a quick description of the fund. We have been around for about 6 years now. We have over 30 portfolio companies. You might have heard of some of them, such as Unite Us in healthcare. And for Ithaca particularly, you must be familiar with Block Power. That's also one of our investments that's going to decarbonize the entire city of Ithaca. I'm very proud of Ithaca for taking leadership in the country to do this initiative. So those are the type of companies we usually look at. And I met Marla about 2 years ago 3 years ago, maybe now, when she was a student at Johnson, and through Cornell Female Founders and Funders, we were doing mentorship office hours, and Marla signed up for one of the office hours to talk about her business, and we were helping her brainstorm some of the challenges she was going through. And we just kept in touch. I have been so impressed by her approach. And the thing about being a venture capital investor is when we invest in early stage companies, we're planning to work with this company for the next 6 years, 8 years, until the day that they go through what we call an exit. So we are looking for people that, we are truly impressed by their capabilities, abilities, but also people we really want to work with. And Marla came with the passion to solve a really important problem in our healthcare system. And through the time we have worked together, we also learned how data-driven she is, how iterative she is, and building this business with all the right mindset. So when she was eventually coming out of VRA and looking for institutional investors, we felt very privileged to have the opportunity to be one of her investors and be able to work on this together.
Amazing. This dream team with the both of you, and why we're so excited to have both of you in this conversation together. Well, back to Marla for a second. So Marla, you mentioned that you raised an angel round, and then you went through an accelerator, and you were able to raise about $2.5 million. And frankly, man, you made it sound so easy. But let's just take a step back, and can you share what that fundraising process looked like in practice? And what's the behind the scenes there, the good and the bad and the ugly. So that way we can share what this looks like in practice from the founder's perspective.
Yeah, absolutely. Well, it was anything but easy, I will say. And you hear always the highlight reels, the TechCrunch articles that come up, and you never hear the blood, sweat, and tears that went into raising. And so, just goes to show, you hear these stories and it may sound overwhelming just because it seems like people were able to put together a multi-million-dollar round, tens of millions, and what seems like a blink of an eye, but it's not at all the case. And it's a ton of effort for anyone going through the process. So the first thing I'd say is we were really intentional about delaying fundraising as long as we possibly could. And I'll say that just because I talk to a lot of prospective entrepreneurs and entrepreneurs who are talking about, when is the right time for me to begin fundraising? And I feel like with fundraising, you really want to go in with the traction and the momentum behind your back. So when you're in conversations with investors, they're excited about you and they're coming to you. They're the ones who are actually reaching out to you because you have a lot of traction, momentum, the industry behind your back, versus if you're a bit earlier on and you're still struggling to get that initial traction, you're going to be spending a lot of time in your day doing cold outreach, just trying to get in touch with anyone who will talk to you. And the time spent fundraising is time that's spent away from building your business. So we were really heads down for the first 2 years, really just building the company and just making sure that we had product market fit. We were getting users. We were building something that our users actually wanted, so that when we went out to do fundraising, it was more about who was the right investor for us and who did we want to spend, to Momo's point, the next 6, 8, 10 years working and building with. And so in terms of how we approach the fundraising process, it's easy to say delay raising as long as you possibly can. We bootstrap for the first year of our company before entering our accelerator program. And we went and together, my co-founder and I put together about $8,000 between the two of us to build out our initial MVP. And that $8,000, quite frankly, kept us going for about 7 months from that time after graduation until when we got the accelerator program. And that was us being incredibly cognizant and careful about where we were allocating money, how we were spending resources, doing everything we possibly could in the most scrappy way possible. And then when we were ready to begin the process and had enough traction to apply to accelerator programs, we applied to everyone from Y Combinator to Techstars to ERA, went through the processes for these respective accelerators all at the same time. And then we're ultimately able to get into ERA, which was great, but we wouldn't have been able to get into an accelerator in my eyes if we didn't already have some initial traction behind us and some initial momentum to say that there was something here and we could actually become a venture backable company. And so in our case, the traction that allowed us to get into ERA was we had 500 clinicians signed up onto our wait list. And so prior to that point, we didn't have really any product. We just had that very minimal MVP, but we did have all of these wait list signups, which was just a function of us putting up a landing page on our site and putting our value proposition and then reaching out to clinicians and getting as many signups as we possibly could. And so during the accelerator interview process, it was really talking to the managing directors about how we were going to convert, how we were going to grow our user base, how we were going to be able to take those next steps to really expand into the market and use this as our initial wedge point. And then the accelerator gave us about 100,000 and took, I think it was 7% on that SAFE, which we discussed earlier. And then through the accelerator, we didn't raise any additional money. Other people in our cohort did take the fact that they had gotten into the accelerator as a piece of momentum to go back to other angel investors that they had spoken with, or friends and family, or it was primarily angel investors, but use that as momentum to raise additional money on that SAFE. But we decided that we didn't want to dilute ourselves further, and we felt that we'd be good for the next 6 months, and we had enough runway to get us to that seed round. And so, and then from there, we just continued to be really scrappy through the accelerator. We spent the capital that we had raised, or they had provided us through the accelerator, on only those really high yield resources. And we're very, very careful about capital allocation. The money, just to give a sense of where it went to in our case, was primarily spent on engineering resources. So paying our engineers and continuing to improve and refine the product as we launched it 2 months into the program. And then I think something that isn't spoken about as much as it should, but going back to something Momo said earlier, in grad school, I began that networking process with investors. And it was really keeping a CRM of all the investors I had the chance to connect with, even informationally, just getting information, getting advice on how to navigate this process, and keeping in touch. I had professors on this list. I had people that were advisors in the space. And I just would send continuous updates every other month to keep these mentors and supporters on our journey informed on how we were progressing. And so, and this is the same for the accelerator. So through the accelerator, we were able to meet a lot of great investors. And so while we didn't officially kick off fundraising until about mid-April, we were still able to keep these people in the loop into our raising process. And so I think it's really, really important to keep these people that you're connecting with informed on your journey, just so that when you are officially able to raise, you can go back to those people you've initially connected with and let them know that you are ready to kick off a seed fundraise. And something that we also leveraged this group with was we went back to these individuals and said, no, this is, we're looking to raise this amount. We've done all of this research, and these are the 30 funds that we want to speak to based on who we know is investing in this space. Do you have introductions to anyone at these funds? Ideally, this partner who has invested in companies in this space, in digital health or health tech. And so we built out a Google spreadsheet wherein we put all of the names of all of the funds that we were looking to speak with and the partners wherein relevant, and just sent this out to our entire network of advisors, supporters, friends, and then had people fill in their name if they knew someone could make make an introduction, because through the fundraising process, as much as you possibly can, you want to be getting in touch with that fund through someone who has a connection or an introduction there. The best possible introduction is a founder in their portfolio. The second best is another investor, and then or friend of the partner or associate at the fund. And then the last possible way you want to get in touch is cold outreach. Not to say it doesn't work, in particular if you have a compelling cold outreach email, it definitely can work. But as much as you can, you want to be leveraging those warm connections to get in touch with funds. And so that's really how we ran our process. And it was also tiering out tier 1 investors. So those were the investors we wanted to get, ideally would lead our round, tier B or tier 2 and tier 3. And so we started pitching tier 3 just so we could start to get that feedback and hear what they were saying, if they were passing, why they were passing. And that helped us to refine our pitch and story as we started to pitch to tier 2 and tier 1. And then something that you'll hear a lot is, I'm really interested, but I won't invest unless there's a lead in place. And so what we did is we kept this note of people who said this to us throughout the process. And when we finally had a lead, we were able to go back to each of these individuals who had indicated that they were interested, but they couldn't say yes until they had a lead, and go back. And then we were able to close the round within, I think, 2.5 weeks of securing that lead. So I think it's like, the thing is, fundraising just takes a long time. So you want to really run a quick, a tight process so that you can get back to building as soon as you possibly can.
Well, that was fantastic, Marla. You really opened up what this process looks like from the founder's perspective, and it's hard, but there was a process there. So take note, those that are about to go through this or are thinking about going through this.
Marla's Hopscotch is the first company in that ERA cohort to receive a term sheet from an institutional investor. So that process works.
I love it. I hope everyone, this is a recording too, so listen back to what Marla just said, because those were some beautiful words of wisdom by an expert.
Well, look, and the goal isn't necessarily to raise the round, it's to raise it as quickly as you can so you can get back to building.
With the investors that are the best fit.
Exactly. And that's a great point that Momo mentions. We spent a lot of time assessing fit and who was really aligned with our values as a company, who we could see ourselves really partnering with for the long haul, because you're going to go through a lot with these investors and you want to make sure they're in the boat with you every step of the way. And you like these people as people and humans, not just as sources of capital.
That's such a great point, and such important thoughts that you gave throughout. And so hopefully folks took note of what that looked like. Now, before I go to Momo and talk about what that process looks like from her perspective of an investor, so that way founders that are listening, you know what to expect or what's happening on the other side of the wall, I do have a question for Momo from our audience based on something she's asked or said earlier. So Momo, you talked about your focus on diverse teams. Can you discuss what you found that make diverse teams, such as women and BIPOC founders, particularly successful? Why do you invest in them?
Yeah, that's a really great question. So based on all the portfolio companies I've worked with, which I have been working on 12 boards of startups, and it's when the companies have diverse teams, they bring different perspectives into the boardroom. And I'm sure the meetings that I don't see, which when they build a company on a daily basis, when people come from different perspectives, that they're able to build a more intellectually honest opinion about how to move forward, how to build. And especially when a team also have the emotional safety to be very transparent with each other, because startups sometimes can get very stressful. And then there's, you have to have people you really trust. But it's being able to have very different opinions and very different perspectives that ultimately, what I see is teams with diversity tend to perform better, because they go through this more thoughtful process in every decision they make, right? So it's not because because the team all come from the same place. They are all the same gender, so they kind of think very similarly. They move quickly. Is the fact that every decision they have made, they have talked about it. They have strategically think through it, and then they have tested out because they come from different places. They have different opinions. So being able to evaluate as many options and as many opinions as possible tend to help the team be able to execute on the superior strategy. So we find them to perform better.
That's fantastic. So, investing in diverse founders isn't philanthropy. It's because it makes good business sense and they perform better. And by the way, there's just a lot of data to support that at the higher level. So startups founded and co-founded by women return over double per dollar invested compared to their male counterparts. And PitchBook found in a 2019 study that female-founded startups exit faster than male-founded startups. And one of our team members is going to post a link in a chat of a report that was recently put together by a team of Cornell alumni, Cornell female founders and funders that highlight some of these statistics.
And there was a report, there was a study done by First Round Capital through 10 years of tracking that teams with diverse founders outperform by 60%.
So there you go. When you talk about it from the data perspective, how do you pass it up? Well, I'd like to go back to the investor side of what was happening behind the scenes. So you ended up invested in Marla's company. So what does the fundraising process look like from the investor side?
Yeah, so I would say from the investor side, we try to first evaluate if from an investment thesis standpoint, if this company is a good fit for us. So like I said at the beginning of this session, that we're looking for game changers that really change people's quality of life, that improves people's quality of lives. So with that in mind, we're looking for companies that can solve a lot of the massive infrastructure, healthcare, climate problems out there. And so when we look, that's the first filter, is whether this company is building on a solution that we think would match our investment thesis. So there are a lot of great companies that we don't talk to or we only have one meeting with. It's not because we don't believe they will be successful. It's the fact that they don't meet our investment thesis. And this goes back to what Marla said earlier, is that you want to find investors that's a good fit, that understand your space, that are looking to invest in your space, because otherwise you're just wasting your time because that's not their investment thesis. So that's the first layer. And then, so every year I look at about 1,000 companies, and out of the 1,000, I invest somewhere between 3 to 4 companies. So after the first layer of realizing this is something that matches our investment thesis, we kind of take a very quick look at the team. So some funds only invest in second-time founders or experienced founders, where for our fund, because of our public interest as part of New York State, we want to invest in first-time founders. So the founders that have already had tremendous success in the past, they can easily raise capital. Those are not really the company that's a good fit for us. So that's the second layer of fit. We're looking for founders that this is their first time building a business and we want to go through this challenging journey with them. So the third thing we look at is whether the market is big enough. So when we look at a company, we kind of take a top-down approach and then we take a bottoms-up approach. So we both look at the whole space from a macro perspective, where we look at how big is the problem you're trying to solve, which is where we do the initial market study. And it's very helpful when we receive a deck from a friend, from a founder, or from like a fellow investor, that the deck actually describes the market space very well and gives them some initial concept about the size of the market. And we prefer markets that have a very large size, mostly because that means there's a lot of room to have multiple companies be successful in this space. And the second part is because the market is so big that it gives the founders time to make some mistakes and make a lot of adjustments. And then we look at who are all the players and the existing solutions in the market. So sometimes we meet founders that come to us and say, we don't have any competitors. And that's never a true statement. there's always some sort of existing solution. It's what people are doing right now. It might not be what this particular company is offering. It can be something that looks completely different on the surface. But for us, we look at a space in terms of like, what's the existing solutions out there? And then we look at if this solution built by this company is going to significantly make improvement. So when people come or present a deck that's very vague, that say we have a superior product, that really doesn't mean anything to us. But if they come to us and they have done their customer discovery, they have built out MVP, and they have data where they say, using our solutions, this customer improved their productivity by 50%, or they decreased the amount of time they use to assess projects by 90%. Those are the things we're looking for to understand, okay, so this company and this strategy is really going to make a significant difference. So those are like everything we look at the market, focusing on the size of the market and also like how it is in terms of like the current players in it. And then we dive into the smaller part where we kind of build our thesis from bottoms up, where we really look at the team. In an early stage company, once you have an understanding of the market and you believe there's a large opportunity for improvement, then the most important thing is which team is going to be uniquely qualified to build the solution, like which team is going to win in this space. So we look at the founder's background, like Marla talked about her journey. She has been in that frontier of working with families, working with children, and working with all the players in the space. So she has personally experienced, worked, and understand the space very well. And that's always something we look for. It's not just something that people come up with because they think it needs help, but it's somebody who has really worked in it and understands the elements and the challenges. And then we look at the diversity of the team. Like Marla built a team that comes with a lot of brilliant people that all want to solve the same problem, but yet they have a lot of diversity on the team. So that's really what we prefer. It's that difference in opinion, that they're all brilliant, that they can come together, talk about it, and work on being able to come with that solution. And then we look at teams that we want to see a track record, especially with first-time founders. A lot of times we do a lot of reference calls. A lot of times we try to work with them for a little while to kind of get to know them and understand them before we make a decision. And it's also important that we look at patterns of people that have really been excellent in everything they have done. So they might be a first-time founder, but in every category they have ever worked in, they have always been a top performer in that category. And those are the patterns we look for. Then we dive, once we have built conviction into the team, then we take a look at the product and we see how this product really solves the problem. Is it incremental? Is it game-changing, but also at the same time, how much of a barrier it is for other products to come in and compete. And at the very end of this, if everything else adds up at this moment, we then look at the price of the deal. At the end of the day, venture investing and almost every decision in life, it's about risk and reward. So we're trying to calculate whether the risk and reward is a good solution for us. Every startup's going to have its risk. Every stage of a company have a different kind of risk. And the earlier you go in investing in the company, the earlier stage you go, the more risky it is. So we want to make sure that the risk-reward balance works out, that we believe that, okay, here are the risks. We feel comfortable taking it because if it works out, here's the reward we're going to receive. So that's when we dive into the term sheet to understand, the price of the round. What does it mean if we put in this amount of dollars? What would that mean if the company gets to a certain place? And when we get to exit, what does return look like for our fund? We're an evergreen fund and New York Ventures, so every fund has a different return profile they're striking for as well. So at the Evergreen Fund, we do look for returns so we can continue to reinvest and put money to work in the ecosystem.
Well, thanks so much, Momo. That was so comprehensive, and hopefully folks found that helpful in thinking of what do investors do all day, and now you can tell that they are extremely busy and they have a lot going on across many dimensions. So I want to just take 2 more minutes to cover one more topic with you, Momo, before I open it up for audience Q&A. So audience, start to put in those questions. We've gotten a lot so far, but keep them coming. So, Momo, where does this magical funding come from that venture capitals have? So, New York Ventures funding comes from the state, but more generalized, where do venture capital funds get their funding from?
Yeah, so very much like the life journey of a startup, so is a venture capital fund. So there are some very mature funds out there that we all know about, like Andreessen Horowitz, like NEA, and then there are some new funds. Like there are funds that are just getting started. Is there Fund 1 or Fund 2? Usually for a fund to start building its own first fund, it's almost like a startup raising its first round of capital. It's usually from angel investors, and for funds, usually it's wealthy family offices, individuals that trust them and want them to invest on their behalf. And as the fund grows, a lot of times they're able to attract institutional LPs. So in every venture fund, there's LPs and there's GPs. So the LPs are the limited partners who give the venture capitalist their money to invest on their behalf. And the GPs, the general partners, are the partners who run this fund, who manage the LPs' money for them, and they charge an operational fee. And if the investment pans out and they have a successful exit, then they split the profit. So the money comes from LPs for every single VC fund. And LPs have individual LPs, family office LPs, but the most important player in the ecosystem are the institutional LPs that usually could be foundations, sometimes they're banks, but most of the time they're college endowments.
So going back to our early conversation, what are some opportunities for venture capitalists, these GPs, to improve their performance to their LPs?
Yeah, so we think a lot of the performance will be improved if they continue to invest into diverse teams. And I think this is, LPs being the beginning of this venture journey. I think it's really important for LPs to care about who their GPs are. And the fact that we know emerging managers, the new fund managers, a lot of times provide equal or superior returns. And these tend to be some of the new managers coming into the space. And this is a great opportunity for LPs to be able to deploy capital to drive superior returns and also invest in diverse managers who tend to invest into diverse teams where we can fix the ecosystem and be able to drive superior returns from like the beginning of the journey.
Yeah, I think that's such a great point. We know that venture capital firms with women partners are twice as likely to invest in companies with at least one female founder, or 3 times as likely to invest in a company with a female CEO. And while women invest more in women, the unfortunate part about where we're at with limited partners is that there's such a dearth of these female asset managers. Just to put a finer tooth comb on that, a 2019 study by the Knight Foundation, so a really reputable organization, showed that only 1.3% of the total of $469 trillion in assets are overseen by women or minority-owned businesses. So that is such an abysmal number. 1% of the total assets are overseen by women. And so if we really want to increase access to capital and unlock this capital, it feels like we need to do more to get more money in the hands of these female funders, so that they can then invest in female founders like Marla, which we know do better financially. And so this feels such like an opportunity. And just to give it a way for folks to participate in this opportunity to unlock this capital, an incredible group of Cornell alumni has put together a petition, and actually you're going to see it on the screen in a second, where we're looking for signatures to come along to this movement that we're about of how do we increase access to capital. In particular, as Momo mentioned, college endowments are one of the big limited partners or LPs in venture capital firms. So one of our goals here with this petition is to increase access to capital, but bring more transparency to the opportunity of college endowment. So take a look at that petition, sign it if you'd like, no pressure, but we'd love for you all to get involved with this movement. Now we have about 12 minutes left, so I actually want to turn it over to our audience Q&A. So one question we got from the audience, Marla, loved the methodical process of fundraising with warm intros. So question for you both, is it best to get to know venture capitalists early on or approach them only once you're ready to fundraise?
I can start off, Momo. Sounds good. So I think the thing with venture capitalists is we see it more as like you meet a venture capitalist and you're a dot, you're a blip when they first get to know you. And it's tough for them to have the context around how far you've progressed, the traction, the momentum, and particularly how you and your team is really the one to execute on this problem. And so the preferable way, at least the way that we've approached it, is trying to establish our relationship with investors as like a line. So we met them at point X. We are providing them with updates every so often. And then, we're a dot and the next line and point on that trajectory. Then the next update is the next line, and continuously all along the way, we're moving, progressing in particularly a really short amount of time. And so I think that that's almost more impressive for an investor if they're able to say, we connected with this founder 8 months ago, 6 months ago, and look how far they are already, or look how much they've achieved in this short span of time. So I'd say that, it doesn't hurt to approach investors, when you're ready to raise. In our eyes, it's, in my eyes, it's far more preferable to try and establish that relationship early on so that you can showcase to them the traction and the progress that you will be making, regardless of if they're going to invest in you or not, just so that you can show them that, whether or not you invest, this rocket ship is still taking off, and you better get on if you want to be a part of the journey.
Yeah, exactly. So from an investor perspective, I would say we prefer to meet founders early on as well, because a lot of times, so Marla mentioned this, they're the lead investors and they're the funds who don't lead. And for our fund, we don't lead because they're a public fund. We don't feel like we should put a valuation into a private startup. That shouldn't be part of our job at New York Ventures. But so like a lot of times we prefer to meet the companies early. So when they get that lead investor, we usually only have a very short time period that we have to make a decision and do all the diligence work. So if we meet the founder early and we have been working with them for like 5 months, 8 months, sometimes we put in our first check after knowing the founder after a year or 2 years, is the fact that we know we can work with them because we have a very long and challenging journey ahead. And so like Marla mentioned, it really helps us to track the progress they have made. Sometimes it's about because the companies want to make a pivot, we follow their path and we understand the thinking. So it's not just a number on paper. We're like, okay, why did this company did this? We actually have been involved and we have been talking to them this whole time. Usually we catch up like once a quarter. So the major decisions, we understand the thinking. We understand why the market's giving them certain kind of feedback. So all that build up is going to help us get to know whether we want to work with this team. And then when we have that limited short period of time, we can make a decision very quickly because we actually already have like a year of data point of interacting with the team, instead of just a data room and tons of information on paper. Because at the end of the day, whether you're building a business or investing in a business, it's a people business. That's what it boils down to.
Excellent. And building that relationship and trust over time is such a central theme to what you both said. So one other question we got, what are your thoughts on giving away a certain percentage of your company and if it's worth the accelerator capital or mentorship?
I can take this one, I guess. So I would say that in our case, it was absolutely worth giving away the equity that we did for participation in the accelerator, just because I think you have to think about the cost of capital for you as a founder and the fact that all capital, like different capital will be relatively more or less expensive that you accept. But particularly in the early days, when you're raising a pre-seed or an angel round, that's going to be the most expensive capital that you give up, because that is the riskiest capital that anybody's going to be putting into you in these early days. And so you could be accepting capital from an angel, friends and family, and it's going to be expensive capital. Or you could be accepting capital in the early days from an accelerator, which is another option. And in my eyes, I saw the accelerator as the more advantageous path, because in addition to the funding that they were giving us, they were also giving us a community. And particularly if you're a first-time founder and you don't have a network established, to Momo's point, once you're a serial entrepreneur, you founded, exited multiple companies, you can raise easily. But when it's your first time doing this, you don't have a track record behind you and you don't have a Rolodex that you can call upon, you really need to acquaint yourself and network within the space. And it's really, the space is small. It's really just being able to get to know the right people, being able to establish those relationships. And so with ERA, which was the accelerator that we ended up ultimately deciding to join, the managing directors knew virtually everybody at every fund in New York, as well as most in the Bay as well. And so they were able to really help us get to know, firstly, which are the right funds to target. And then when we were ready, were able to make those warm introductions to us. And so I think that was the second really important thing that was helpful to us in terms of just being able for us to build up that network. But the third thing I'd say was the mentorship that we were provided. And so ERA in particular, and every accelerator has a different sort of structure. They have over 500 expert mentors that are in their community. And so through the program, we connected to probably 60 mentors who took 30-minute meetings with us. Some were more helpful than others, granted, but we were able to connect with some fantastic people who provided us the opportunity to some of our largest biz dev deals right now, some really salient advice on the product side, or helping us think through our marketing strategy, or even just something like we were building out a pro forma model for raising, and there was someone who had spent 20 years in investment banking. And he's like, I'm happy to take a look with you at your model and see how we could improve it. So it was really this community of mentors that was able to support us in so many different areas, wherein we would have otherwise been having to go out and work with a freelancer or seek out a consultant to help us in some of these areas. So I think particularly in these early days as a company, you're also building up your business development pipeline and getting contacts for potential partnerships and sales opportunities. And so that's something that an accelerator can also really help you with in terms of helping you to make those right introductions and connections to really help you make progress in your business. So in my eyes, the accelerator was an expensive form of capital in the early days. And yes, you do give away a fair amount of equity. However, it paid off in dividends with allowing us to make traction on the business sense, but also opening up a network for us in terms of raising.
Yeah, thanks so much, Marla.
Yeah, and when we look at companies, a lot of times, once they go through the accelerator program, it's also, we know for a fact, whether it's Techstars or ERAs or Y Combinator, they look at thousands and thousands of companies before they choose that 10 or 12 for that cohort. So we know they have already came through rigorous vetting at the point that they become one of their cohort companies. And the second thing is it's the community, but also like the peers, the founder community, because once you become a cohort company, you're connected to all the founders before you and after you. And some of the learnings that my portfolio companies tell me always come from their peers. When they have a bad experience with an investor, they talk among themselves. So those are a lot of information you wouldn't be able to get elsewhere if you're a first-time founder.
Absolutely. And the last thing I'll say too is to Pomo's point on the community, being a founder is hard, even just amongst the learnings. It's a tough journey and it can be very lonely sometimes. And so you really can't overstate the importance of just being in the boat and having a group of companies by your side who are also dealing with the same stuff, whether it's like, it's, you know, you'll see every problem that's hit your way, but it's like you just feel you have people behind you and next to you who are also able to really support you through the bad days. So that just from the perspective of caring for yourself and your mental health as a founder is so important.
Yeah, such important comment. So we have about 2 minutes left. So I have one quick question from our audience that I want to get to. So great insights from this panel. What are some ways that institutional investors, such as college endowments, can take advantage of this opportunity to increase performance by investing in more women and BIPOC fund managers? So Momo, do you want to give a quick minute on ways they can do that?
Yeah, I would say the two quick ways to do it. The first one is invest in emerging managers. Design a emerging managers program so you can put your money to work to a lot of the new managers that are coming in that are women, that are people of color, that bring a different perspective, and they're so brilliant and good at their jobs. So make sure your fund has the ability to design a program like that so you can invest in them. And the second part is ask the tough questions. Like as an LP, you receive LP reports and you speak with these funds that are part of your portfolio. Ask them what is the ratio in their portfolio? Are these GPs investing in diverse teams? Are these GPs hiring diverse investors into their teams? Are they promoting diverse investors into GPs so they build diverse teams and they invest in diverse teams?
Amazing. And eCornell team, if you want to put up the petition there one more time too, because how we can increase and unlock this capital is by getting college endowments to increase transparency here, and along with developing some of the amazing programs and recommendations that Momo highlighted. Well, that brings us to the end of our time, but we're just so grateful for everyone joining us here live or those listening to the recording. So huge thank you to the eCornell team, and also a special thanks to those that helped organize today's session, the leaders of Cornell Female Founders and Funders Alumni Group, Megan Cross-Breeden from Amplify Her Ventures, Susan Danziger from Utopia Holders, Dem Kemper from Golden Seeds, Elisa Miller-Out from Chloe Capital, Shelley Porges from Beyond the Billion, Jada Yang from Infinity Road Ventures, Genuine Core, a whole bunch of group of students that are behind this effort as well and have helped us marshal interest in this space. And we're just so grateful for the folks at CREA for helping us to promote the event as well. So this event is part of a larger movement of Cornellians coming together to increase college endowments transparency around diversity in their investment dollars and how we can unlock capital to get more funding to diverse founders. So thanks everyone so much for joining us here today. And we hope you have a good rest of your day, and happy National Women's Entrepreneurship Day as well. So hooray, hooray, Celebration Station. And I hope you all have a good rest of your day and evening. Thanks, everyone.
Thanks, everyone.
Thank you.